Not coincidentally, by the way, the gold price went up 26-fold. It's difficult for me to understand why people don't own physical gold as a savings product. I was pounding the table on oil and gas, not because I knew there was going to be a war. Precious metals and precious metals equities in the US market comprise about 1/2 of 1% of total savings and investment assets in the United States. The 4-decade mean was 2%. I paid into Social Security for 60 years. So of our private net worth, 160 trillion is spoken for by federal debt and deficits. And that number increases between on and off balance sheet liabilities to the tune of $4 trillion a year. We can be honest like the Argentines and default. Send a letter to the bondholders, and by the way, the Social Security recipients, and say, yeah, we know you promised. Too bad, so sad. You need to prepare for it. To the extent that you think that your 2026 fixed income is going to sustain your current lifestyle in 2036, you have a rude awakening. What costs you $1,000 now will cost you $4,000 then. So you need to adjust your savings, your income, and your expenditures.
Talk to me about the natural resource sector. We have had energy prices elevated. We've had gold. It seems like gold and silver both have found somewhat of a base here. Is any of this surprising to you? And are you looking at any these sectors to make acquisitions, or are you looking at what sectors do look attractive to you?
You know, Andy, I prepared for this interview last weekend by replaying a couple of our old interviews.
God bless you.
Well, one interesting thing is I was pounding the table on oil and gas. And not because I knew there was going to be a war. The
Right.
price levels that we're enjoying, if that's the right phrase, in the oil market are levels that I had anticipated in 2029. In other words, the war front-ended the price escalation that I thought would occur as a consequence of declining sustaining capital investments. Uh, Talking to your audience about Exxon at $95 was a much easier discussion than talking to them about it at $180. So people need to
Right.
understand that.
Right.
The oil and gas thesis is intact, but I'm not trying to say it's cheap. I'm not saying it's expensive either, because if this war goes on, you're going to see a very different level of oil prices. The oil prices you see now are prices in anticipation of rationing. The prices that you'll see in 10 days or 2 weeks if it keeps going are prices that are a function of allocating oil to money, real rationing by price.
Markets are celebrating stable energy prices while the supply side quietly looks more fragile than it did before the last commodity supercycle. As Rick Rule points out here, oil reached levels he originally expected years from now, meaning geopolitical conflict accelerated a structural shortage already forming beneath the surface. That matters because Wall Street still frames energy inflation as temporary rather than investment starvation. If rationing by price becomes reality, retirement portfolios overloaded with growth stocks could absorb a brutal purchasing power shock. Next, Rick Rule exposes why institutional capital abandoned energy producers just before supply constraints became impossible to hide.
It's very different. But the sector is no longer hated. As you know, Andy, I try to go from sector to sector based on hate. And unfortunately, my sector, nothing is hated, which
Right.
means in the very near term, there isn't very much that's compelling. The only objection to that I could raise, and it's not really an objection, the only counterpoint is that almost all Americans are underinvested in precious metals and precious metal stocks. And while they're nowhere near as cheap as when they were 5 years ago when you and I first started talking,
Mhm.
relative to the level that they're going to be 5 years from now or 10 years from now, and relative to the market share that they enjoy in most people's portfolios, they're still very underrepresented. The very high quality gold companies. By the way, I interviewed Amaro Jundi today, the CEO of Agnico Eagle, finest
I'm jealous.
operating finest operating mining company in the country. Uh, the analysts' expectations around Agnico Eagle are based on $3,200 gold. It's kind of hard not to beat the expectation when the expectation is $3,200 and you're selling the stuff for 46. You know, that's the stuff of earnings surprises.
Right.
uh,
Yep.
so there's a reasonable amount of opportunity in the precious metals business. If you're like me and you've been involved in the precious metals business for 3 decades, you don't need to increase your allocation. But precious metals and precious metals equities in the US market comprise about 0.5% of total savings and investment assets in the United States. The 4-decade mean was 2%.
Most Americans think they own inflation protection because their retirement account went up in nominal dollars, but portfolio concentration risk has rarely been higher. According to Rick Rule, precious metals allocations remain dramatically below historical norms even after gold's recent strength, with the sector representing barely 0.5% of US investment assets versus a long-term average near 2%. That gap matters because institutional money tends to rotate before public confidence breaks, not after. Savers waiting for media confirmation may discover the re-rating already happened without them. Next, Rick Rule reveals why analyst assumptions around gold miners may already be obsolete.
Right.
So if those markets merely return to mean, demand quadruples where supply is limited. It is estimated, and I don't know if it's true, nor do they, it's estimated by JP Morgan Chase that the market share of precious metals and precious metals equities at their peak in 1981 was between 7 and 8%.
Wow.
I have no way to verify it, and they admit they don't either. But if you look at a circumstance where the market share to revert to mean grows fourfold, in an environment where the US dollar loses 75% of its purchasing power, and arguably where gold maintains its purchasing power, that would suggest that the increase in the gold price over 10 years, if I'm right about the dollar, increases in nominal terms at least threefold. So that makes a reasonable case. Well, it's difficult for me to understand why people don't own physical gold as a savings product. It's grown at 9% compounded since the year 2000. It's really difficult for me to understand anybody who wouldn't own physical gold that has any savings whatsoever. It's interesting. It's difficult for me to believe, too, that anybody who categorizes himself or herself as an investor doesn't own investment positions in the highest quality gold stocks. Mm-hmm. The Wheaton Precious, the Franco-Nevadas, the Agnico Eagles. And for those who are willing to do the work, those who are willing not just to enjoy beta, the outperformance of gold relative to other sectors, speculating in single asset producers or in mid-range producers, which likely will be taken over, or really truly speculating in juniors and exploration stage companies.
JP Morgan's own estimate implies precious metals ownership once reached nearly 8% of investment assets. Yet today the sector barely registers in mainstream portfolios. What Rick Rule is highlighting is the mathematical asymmetry created when limited supply meets even a partial return to historical allocation levels during a currency debasement cycle. Institutions understand this dynamic, which is why physical accumulation often happens quietly, while financial television debates quarterly rate cuts. Investors focused only on spot prices may be missing the deeper repositioning already underway underneath the market. Next, Rick Rule exposes why physical gold demand and paper market pricing no longer fully align.
Given that you're likely going to enjoy the wind in your back for the next 10 years, it's difficult for me to explain the underinvestment that people have in precious metals.
Yeah.
And then, of course, there's gold. If you believe, as I believe, and I believe that the US dollar loses 75% of its purchasing power over the next 10 years, it is, I think, imperative that you at least consider putting some of your savings in an asset which has a millennium-long track record of maintaining its real purchasing power, which is to say gold. It isn't right for everybody. I get that. But it sure has been right for me. As I say, when I look at the basket of goods and services that I consume, and I look at them in dollar terms, I'm horrified. And when I look at them in gold terms, I'm amused. I would prefer that more of your listeners became amused and horrified.
Yeah, me too. Where do you get the 75% number in the decline rate of the US? Is there some kind of US dollar? Is there some kind of metrics involved in that? Or yeah,
Yeah, I mean, I'm basically simple math. Well, first is history. Uh, the Office of Management and Budget, which was the predecessor to Congressional Budget Office, says that in the decade 1970 to 1980, the US dollar lost 75% of its real purchasing power.
The Federal Reserve insists inflation is moderating, yet the long-term purchasing power trend still points relentlessly in one direction. Rick Rule's argument suggests the real issue is not temporary inflation spikes, but structural currency erosion, repeating across decades of monetary policy experiments. The contradiction is uncomfortable. Policymakers praise price stability, while the dollar steadily buys less housing, food, healthcare, and energy every cycle. For retirees depending on fixed income streams, that silent erosion becomes financially devastating long before headlines acknowledge the damage. Next, Rick Rule unravels why historical dollar declines and modern debt levels create a far more dangerous setup today.
Not coincidentally, by the way, the gold price went up 26-fold, but we'll leave that for a different discussion. When I look at that, which is to say past as prologue, and I look at the fact that the basket of goods and services that I consume, that my household consumes, and by the way, I'm an old, fat, bald, rich cheapskate. I don't buy much. Um, uh, that number seems completely consistent with the fact that the basket of goods and services that I buy seems to increase in nominal price by between 8 and 10% a year, compounded. In fact, that number with compounding suggests that the US dollar may lose more than 75% of its purchasing power. It's instructive to look back to 1913 when we instituted both the income tax and the Federal Reserve, that the US dollar has in that period of time lost 97%
yeah.
of its purchasing power. When people talk about losing 75% in the context of a precipitous decline, what it really is the continuation of a trend in motion.
Okay, so you talk about compounded interest, and it seems like it's certainly hitting us right now. An interest in, I should say, compounded interest in inflation, or that inflation compounding. Doesn't this put a squeeze and hurt on the economy? Is that what you're seeing with the loans that you make and all of that as a banker?
Well, as a banker, I'm a coward. I mean, one of the things is I'm a throwback to old-fashioned bankers. I have this quaint sense that it's easy to lend money, but it's hard to get it paid back.
Right.
The dollar has already lost roughly 97% of its purchasing power since the Federal Reserve was created, yet policymakers still describe inflation as temporary pressure. This is where Rick Rule's thesis shifts from market commentary into historical pattern recognition, because he's pointing toward a century-long trend rather than a short-term policy mistake. The real danger is compounding. An 8-10% annual erosion rate quietly destroys fixed savings long before most households adjust their expectations. Conservative savers relying on bonds and cash may discover stability itself became the hidden risk. Next, Rick Rule reveals why old-school lenders are avoiding the very credit markets Wall Street still celebrates.
You know, so there's a whole bunch of parts of the economy that I have decided to leave to my competition. An example would be credit card lending. The idea that I'm going to lend somebody money to sustain their lifestyle at 25% interest. How are those goods that they're buying now that they can't afford going to become cheaper for them in the future? I don't reckon. So I have no interest in making consumer loans. I have no interest in making auto loans. The idea that I lend money on an asset that's worth $1,500 less when the person drives it out of the lot is of no interest to me. I don't make loans. I may someday when they're in distress, but I don't make loans on commercial real estate. I I'll get around eventually to the things I do make loans on. I don't make loans to private credit issuers, except in those cases where the private credit issuer sticks to one market that he or she knows well. But these sort of New York City masters of the universe who believe that they can make money as spread lenders to 40 industries, none of which they're experienced in, I have no interest in loaning those morons money. So I suspect probably that my own experience is going to be different than most commercial bankers' experience because I tend to stick to my knitting, and my knitting keeps me in a fairly tight circle. The difficulty that we're having in the economy is that my breed of banker is fairly rare. And, I'm not pretending, by the way, that I'm anywhere near as smart as the guys who run JP Morgan Chase.
Credit card rates near 25% are being normalized at the exact moment household delinquencies are quietly climbing across multiple lending categories. Rick Rule notes that he refuses to chase consumer credit and speculative lending because the underlying collateral and repayment assumptions no longer make economic sense outside perpetual inflation. That directly contradicts the bullish narrative surrounding private credit funds and consumer spending resilience pushed by major financial institutions. The smartest lenders are becoming selective, while retail investors are told everything remains healthy beneath the surface. Next, Rick Rule exposes why concentrated expertise may matter more than diversified financial engineering in the next downturn.
But I don't have to be. Those guys try to know 1,000 businesses, and I try to know 4. By simple arithmetic, knowing 4 when you've been in them for 50 years is a whole bunch easier than knowing 1,000, particularly if by knowing 1,000 your experience is that you're 5 years out of business school. So I guess there's some structural differences between what I do and what they do. But the problems are larger than just the bankers, Andy. I think it's important to look at the underlying financial underpinnings of society, which a banker must do. At the federal level, before your mistakes and my mistakes, or rather, looking, I guess, at our collective mistakes, at the federal level, before state and local debt, we're almost $40 trillion upside down. Mm-hmm. That's a big number. People hear 40 trillion and their eyes glaze over because they can't conceptualize it. Mm-hmm. Whether or not you conceptualize it, you're going to have to pay for it. So you got to begin to get your head around that number. But that number is less scary than a different number. That number is the unfunded value, net present value of unfunded entitlement promises. Mm-hmm. Look at me on the screen. Old people, Medicare, Medicaid, Social Security. We've promised old folks $120 trillion in benefits.
Right.
And we don't have the money.
Right.
I'm not suggesting we're going to get a lot of hate in your comment section. Guys are going to say, well, I paid in, I deserve it. Whether you deserve it or not doesn't matter. It's not there.
Washington debates annual deficits while the far larger entitlement obligations remain politically untouchable and financially impossible to fully fund. According to Rick Rule, the real issue is not the visible $40 trillion debt pile, but the additional $120 trillion in promised benefits with no matching capital behind them. That creates a dangerous disconnect between what citizens believe they're owed and what the system can realistically deliver without severe currency debasement. Investors assuming future purchasing power will remain intact are effectively betting on arithmetic no government balance sheet currently supports. Next, Rick Rule unravels why inflation may become the politically preferred form of default.
I paid into Social Security for 60 years. Mm-hmm. You can't get blood from a stone. Stones don't breathe. And so when we talk about the issues that we face in society or the issues that I face as a banker, I think we need to start at square one. We need to understand that as a society, we've lived beyond our means. And there's a reckoning coming. Mm-hmm. And that reckoning is partially going to result in the decline in purchasing power of the US dollar. Here's why. There's 2 ways out of this $40 trillion in on-balance sheet liabilities and $120 trillion in off-balance sheet. By the way, that number is $160 trillion. The IRS estimate of the private net worth of all Americans combined is 171 trillion.
Gosh.
So of our private net worth, 160 trillion is spoken for by federal debt and deficits. And that number increases between on and off balance sheet liabilities to the tune of $4 trillion a year, $4 trillion a year before the war. Now, there's two ways out. We can be honest like the Argentines and default. We could do that. Send a letter to the bondholders, and by the way, the Social Security recipients, and say, yeah, well, we know what you promised. Too bad, so sad. No money, strong letter to follow. That's not the American way. We kick the can down the road. That's what we do. So we're going to have a dishonest default. We're going to not honor the nominal value of our obligations by inflating away the net present value. If you take that $160 trillion and you devalue it in real terms by 3/4, that number becomes much more manageable.
Mhm.
And I think that's what happens. Is it pernicious? Yes. Is it going to happen? Almost guaranteed. Can you vote it out of existence? No. You need to prepare for it. That's what you need to do. To the extent that you think that your 2026 fixed income is going to sustain your current lifestyle in 2036, you have a rude awakening. What costs you $1,000 now will cost you $4,000 then. So you need to adjust your savings, your income, and your expenditures, and you need to begin to do it now.
The government can mathematically service impossible debt loads only if the currency itself buys dramatically less over time. What Rick Rule is highlighting is the unspoken policy preference for inflationary default, where obligations are technically paid back but in dollars, carrying far less real purchasing power. Central banks rarely admit this directly because outright default sparks panic, while gradual debasement spreads the losses quietly across savers, retirees, and wage earners. The public hears economic stability, yet the balance sheet arithmetic increasingly points toward controlled devaluation instead.